Goal of financial management. Decisions involve choosing among alternatives. If you are making a decision, let's say you have 3 alternatives, what you are doing is you are analyzing which alternative has what outcome, okay, and then selecting the best one. This is the decision making. Now, different alternatives may lead to the achievement of different goals. This alternative may lead to achieve one goal, the other alternative may lead to achieve another goal, and the other one may lead to achieve a different goal. So it is important which alternative you are choosing, and also whether the alternative is directed toward achieving the right goal or not. So in case of financial decisions must be targeted toward achieving an appropriate goal. An appropriate goal can also help to measure the success of financial management. Let's say we have 3 alternatives, and this is the alternative that you have chosen as a decision maker. Okay, so if you have a particular goal in your mind, okay, let's say this is the goal in your mind, and for achieving this goal you have found that this alternative is the best one. Okay, so after you have chosen this alternative, then the people or the party that appointed you as the manager, they can assess whether you could really achieve this goal or not. So keeping an appropriate goal in mind or setting an appropriate goal before making the decision is also helpful to assess whether the management is performing well or not. So before we discuss about the most appropriate goal of financial management, let us think about possible alternative goals. One goal can be customer satisfaction. Okay, this is a possible. We'll see later on that ultimately one goal is considered or well accepted as the most appropriate goal. Okay, so before discussing about that, we can think about what are the possible. For example, some people may argue that, well, the goal must be customer satisfaction. That means the decision must be made in a way so that the customers are satisfied. Another alternative can be employee motivation. Okay, that means if this is the goal in the mind of a financial decision maker, then financial decision maker will always choose the financial alternative that will result in the highest level of employee motivation. Cost minimization. This is another example of a goal. Okay, that means if cost minimization is your goal, then you will always make a decision that will result in minimum cost of production. Profit maximization. Okay, it sounds that very well-known goal. So if you think that profit maximization is your goal as a financial decision maker, then you will always make a decision that will result in the maximum profit. And last but not least is the shareholders wealth maximization. This is another goal. Okay, if this is the goal in the mind of the financial manager, then financial manager will always choose the alternative that will result in maximum wealth of the shareholders, that means the owners. Before we discuss about the most appropriate goal, we need to think about the owners. Because owners actually appointed the financial manager. Therefore, we must think, what does the owners want? Owners or shareholders delegate the financial decision making to the financial managers who will make the financial decisions. So financial managers should act at the best interest of whom? Of the shareholders or the owners. Okay, so shareholders or the owners, because they are working for the owners. What does the shareholders want? We have to know that. Probably shareholders would not mind to be richer. Okay, they will always like to be richer because this is why they have invested their money. If they invest $100, they will always like their investment to have a higher value. Okay, which we call here as they want to be richer. Shareholders also like to consume according to their own preference and time pattern. Okay, for example, let's say the shareholder has additional money now and this line is representing time, so this is time equals 0, that means now. And let's say they want to consume after 1 year, that means when t is equals to 1. So if they have a surplus money of 100, they are investing in the company as a shareholder, because perhaps after 1 year they want to consume for $110. They are expecting 10% return, and they think that they can consume at least for $110. If they have this in their mind, then shareholders should work for satisfying their need. And the third example is that they want to tolerate risk according to their own risk preference. Okay, this is very important. Not all people like to take risk. Some people like to take higher risk. Some people like to avoid risk. Okay, so the shareholders will always prefer to make use of their invested money at the risk level of their preference. So these are some examples of what shareholders want. But we should remember that there are different types of people who are becoming the shareholder of the company, and different people will have different type of desire. Okay, their wants will also be different. So we can say that the different shareholders may have different objective of investing in the business. They may have different objective of investing in the business. So is it possible for the manager to satisfy different objectives of different shareholders? No. This is why financial managers should work for a common objective that may be acceptable by all shareholders, or that may help to different desires or different wants to be satisfied. So we'll try to find that kind of objective. Okay, so if the financial decision lead to increasing share price, so let us think about increasing share price. What happen if we try to increase the share price? In that case, what will happen? The shareholder will be richer. Shareholder will be richer. No shareholder will be unhappy to be richer. Okay, and also they can sell a portion of their shares held according to their personal preference of consumption or risk. For example, if the share price is higher, one shareholder wants to consume only $5 after 1 year, but the other shareholder wants to consume $20 after 1 year. So they can sell a fraction of their share according to their preference of consumption in year 1. Okay, and also if the shareholders think that the investment is made in a very risky project, okay, then what they can do, they can sell a significant portion of the share of this company and use the money to buy a safer company share, or a very safe government treasury bill or something like that. Okay, so if the manager actually try to increase the share price, that will help to achieve any objective or any preference by any shareholder. So what is the ultimate goal of financial management? The ultimate goal should be maximize the owner's wealth, or in other words, maximize the shareholders' wealth. Now, how do we measure the shareholders' wealth? The best measure of shareholders' wealth is firm's share price, because this is the direct way of increasing shareholders' wealth. If the share price is higher, the shareholder can sell the share and get the higher value of their investment. Very simple. So financial managers should make a decision with the goal of increasing the share price. That means they choose an alternative only when the alternative, compared to other alternatives, may result in the maximum increase of the share price. So let's say we have 3 alternatives again. Okay, so if choosing this alternative result in decrease of share price by $10, if this alternative result in increase of the share price by $20, and this alternative result in increase of share price by $15, then which one is the best alternative? Which alternative should the manager choose, or which decision should the manager make? They should choose this alternative, so that the share price becomes maximum. A good decision will result in the increase of the share price. Should all good decisions increase the share price? Or is it only the good decision that will increase the share price? No. The answer is no. Why? Because there are many external factors that also influence the share price. For example, economic condition, sentiment of the investors, interpretation of the firm's decision by the investors. These are some examples of external factors that may also influence the share price. Let's say the financial manager has made a good decision, so share price is supposed to increase. But because of one of these external factors, the share price still may not increase. So how to deal with that? How to deal with that? The answer is the financial manager should focus on what effect their decision should have on the share price. So the effect that should have on the share price, this should be kept in their mind. Okay, so they should always think the decision that should have a positive impact or the maximum increasing impact on the share price. Thank you very much.